Ladies and gentlemen of the crypto space, we're live on a Tuesday, February 23rd. Wow, day before my birthday. At 11:30 a.m. Spot on. We are on time, and that's the way we need to do it. Today's title, how much risk are you actually taking? That is the all-important question, especially in times when we have an event like this, a risk-off event. And basically, it's a liquidity event. It's a supply demand imbalance where there's more sellers than buyers, and that's the way these events play out. And the question in these events is, where is bottom? Have we reached bottom? And maybe we haven't, but that's the whole point of a strategically crafted portfolio. Doesn't really matter if it's bottom because at some point markets turn around. And this is where we get into the conversation of what is a full risk on asset. Are you exposed to just full risk on? Or is there more structure to the portfolio where you have yield bearing positions that when you're that contain risk on assets, they experience depreciation and also the inevitable reappreciation. And during the entire time of going down and up, you're capitalizing on the volatility, producing a recurring revenue stream. And that is what we like to do on this channel. We like to talk about very risk adverse portfolios that capture volatility, converting it into a recurring revenue stream, and being able to see that from the macro perspective and understand that depreciative events occur, they bounce back, and we are taking as little risk as possible, all things considered. And we're going to talk about the most important thing, which is fiat and how much risk is actually there. Let's pop the intro. Today's episode is sponsored by Change Angel, the non-custodial swap exchange for social good. Stop depositing on exchanges, not your keys, not your crypto, non-custodial, DeFi, or nothing at all. Bam! Pop it over to the main screen and see who's in the stream. Did you like, whoa, Noah, my man, risk on, buying opportunity? Sure, this is actually a max opportunity type situation. Based on the QQQ, ooh, goodness, we're below the 200 and the 200 EMA and SMA on the 4 hour. You know, there's quite many reasons, especially technical reasons at this point, to think that there's further downside ahead. We could have a full on systemic event, in which case the Fed steps in and does whatever bullshit they always do. And we got stimulus coming probably in the next week or two, and that's surely going to affect the psychology of market actors. And, well, we'll see. But the whole point is exactly how the introduction laid it out is to be prepared for downside depreciation and capitalize on that volatility. Bam. Earends in the house. What's up? Hopefully you're able to keep up with my questions. Good job, my man. I'm going to try my best. Yesterday was crazy, and I literally I couldn't keep up with the stream. So that's awesome, and it's quite exciting to see so much commentary, so much participation, and as always, I hope that I'm making a good impact. Bit is in the house. Always a pleasure. Can we talk about security a little bit? Well, feel free to ask questions because security is obviously a broad topic. Are we talking about security as in custody, self custody, a ledger device, or security with regard to the DeFi platforms and how secure they are, given that they are some trust minimized custodian? And there is custody involved. These contracts are holding assets, and that's we have to consider the risks there. But this is why I like talking about the risk associated with fiat because that's not risks. That's beyond risk. That's a guarantee. That's a guaranteed loss of value. And that is quite meaningful. And that really makes allocation of value to assets um, a requirement. You cannot hold value in dollars. Dollars are a vehicle for transferring value, for payments, for settling debts. And that's the truth. Empirically, based on data. Who the hell is going to hold an asset that's guaranteed to lose 15% of its value every year? That's crazy. That doesn't make any sense. Julie Young's in the house. Always a pleasure. Carlos, I de-risk significantly thanks to your video. My portfolio appreciates it. Thank you guys. I appreciate you guys, and I'm happy to see other folks are benefiting from the ideology and concepts we discuss. Um, De-risked. I mean, listen, if you're exposed to a risk-on asset, literally just holding like uh, just something pure, that's risk on because it's not capturing any volatility in the form of a recurring revenue stream, and it's literally just going to go up and down in value. And that's how you create. That's how the word bag holders was created back in 2018. Were just kept going down, and people were just holding the asset, and it does nothing. But that's why this time it's different. These products and technologies in the DeFi space means, yeah, sure, the asset is going to keep going down in price, the principal value, but it's going to be producing a recurring revenue stream based on the transaction volume going through the particular system in question. So during the entire time of the depreciative cycle, you're making money, and that's what we can use to live on. And then the market bounces back inevitably. So it makes you have a capacity to. It's not strong hands. It's not that diamond hands bullshit. I mean, it's not bullshit, but it's meme, and it's hyperbole. What it is understanding the notion that markets fluctuate. They go up and down, sometimes for extended periods of time, and the whole point of the opportunity, uh, the um, um, the apparent opportunity currently in front of everyone, is an ability to hold assets that work for you instead of you working for money. And that's incredible. Bitter says, "Are you going to participate in Flare Network?" No interest whatsoever. Not that I have any disregard for the technology, I just have no interest in it. Erin, can you walk us through staking Rent BTC on Keep It Out for arbitrage participation? I don't do walkthroughs. We'll go for Bankless HQ and DeFi Dad. But staking Ren BTC on Keep It Out, it won't participate in arbitrage. You're basically providing liquidity to the platform, and it gives you some very meaningful yield. That's a great place to allocate value. And you're talking about the same risk as any other DeFi platform, except and how do you assess that risk? You're dealing with the Ren team who built Ren VM. And I would say they're a much lesser risk as compared to startup DeFi projects that have an unproven track record, and that is a great deal of risk. That carries great risk. We've seen some DeFi breaches, but empirically, the data suggests that the DeFi breaches are slowing, and when they breach, they're getting larger, which makes sense because there's more capital that's deployed across the space. Um, what's interesting is that the smart contract platforms are basically iterative. So when a new one pops up, or everyone's always learning from everyone. So and every event, the developers are able to fill the holes with more structured code, more resilient code, more reliable and dependable functionality. And what's happening is the Legos are building, everyone's learning from everyone, and it's just evolving at breakneck speed. It's really extraordinary to watch. So my recommendation with regard to security and risk consideration is to stick to the majors, the large platforms that have literally had no security breaches and are entrenched with network effect. And therefore they will carry the least amount of risk, allowing you to achieve the desired effect, the desired portfolio construction that you're looking for, while minimizing the risk of the value allocation. I mean, if you gotta assess the risk and you're worried about these DeFi deployments, if you hold your money in dollars, you're guaranteed to lose 15% per year, and it's maybe even more. I mean, literally, it was 8 to 12% according to the Chapwood Index, and that website was decommissioned. I'm not surprised. Probably, you could get into conspiracy theories, but those numbers were probably going to be pretty goddamn scary for 2021. So 15% is, gut instinct short of where real inflation is going to be, at least inflation as seen by the general public with regard to prices. I mean, clearly we have asset price inflation. If I went to buy a share of Tesla stock for $300 and now it's $600, you just had 100% inflation. So you got to remember, inflation is relative, and it's not easy, and it's causing volatility across the space. Asset price inflation is not. This is not the way the system is stable. It's volatility to the upside. It's a liquidity event to the upside. There's not enough sellers. Interesting way to think about things. Fiat is highest risk, lowest reward. Yeah, man, you Toomey got it right on. You get zero reward, and it's beyond risk. It's a guaranteed loss. Something major to consider. Curve sounds and looks too good to be true. How can it be? So Curve, I'll show you my position. I pay taxes on this shit. So I bought Curve substantially cheaper. Um, my Curve position was at like $1, and it dropped to 20 cents, and I've been adding a little bit here and there. But I have a large Curve position. This is a lot of money, and I've been lucky enough to accrue it over the last year and a year and about years since Curve started catching fire. I was one of the original liquidity providers to the platform. But with this position, the interest is crazy, and it's sustainable. So I literally have a full-time, relatively minimum wage job here, earning $74,000 a year. Taxes I have to pay, but the yield comes from transaction fees. And if you want to understand how that works, the daily volume is $378 million, obviously, considering this depreciative cycle we're going through. But these daily volumes have spiked over the last 3 weeks, not just this week. So that's meaningful. So I expect these volumes to just keep going up over the coming years. We could clearly have a lull in the market, but I think just DeFi is going to capture value, and no one's going to want to leave it. There's just too much opportunity, and the monetary velocity is vertical, and the yield is real as compared to the legacy financial system, which is yield starved. So my expectation is 10 to 100x in this volume over the coming years. So that's where my excitement meter and my interest meter comes in. So can you imagine 10 to 100x on the yearly earnings? 740 to $7.4 million a year. Woo! Exciting times. So that's the name of the game for Curve. The interest is denominated, or the yield is denominated in dollars. They literally give you pure dollars. I mean, clearly it's 3CRV. So, but those are DAI, USDC, and USDT, your choice of your dollar stable coin. And really, USDT has been de-risked with the settlement of the New York Attorney General's legal action. And that's good to see. We always thought that USDT was a euro dollar of sorts in the crypto space, and that's great. And that's awesome. And I think that resolves a lot of FUD, fear, uncertainty, and doubt. And the platform has been de-risking itself continuously. The developers are next level brains. They're going to be titans of industry, and this platform is definitely a special component of the DeFi space. Basically, the forex of the crypto space, dealing with these stablecoins. The volume flowing, look at that, $171 million has flown through 3Pool in the last day. That's incredible. Squanchy's in the house, fellow Floridian in the house, Waves in the house. Always a pleasure. Coach checking in. Charlie G, my man's good stuff. Good stuff. Security when depositing on sites in Celsius or Nexo. Skip over Nexo. They're clearly deploying their capital to leveraged exchanges, and that's why the liquidity event and Kraken's malfunctioning price matching liquidated a huge amount of positions, putting Nexo in a very difficult financial position. So their deployed capital was liquidated, therefore Nexo's capital was liquidated, and they're probably running around scrambling to cover the losses. So Celsius handles things very differently. If you're talking about deployment to Celsius or BlockFi, I would argue those are relatively decent places to allocate value. Once again, I always draw back to the fact that you are guaranteed to lose value in fiat. And in these places, there's risk. It's not a guaranteed loss, which means literally taking any risk whatsoever is better than a guaranteed loss of value. So, really, it makes the conclusion easy that the deployment of capital that is currently stored in fiat to basically almost any risk asset, the appropriate course of action. And the task that you have is to assess the risk, such as the title of the stream. How much risk are you taking? Now, clearly, if you own an asset, if you just own Bitcoin and you're generating no yield, you're in a risk on position, albeit the fact that Bitcoin has produced 200% appreciation annualized for the last 10 years, quite the de-risked asset. Incredible. But if you're buying like some random altcoin, you got some serious risk on the table, unless it's generating yield. And if you have the potential, if something ran 4, 5, 600%, it could easily hit with a 50%, you know, slash in its price. That's some serious risk. So everything I talk about is complete risk aversion. The vast majority of the portfolio is Bitcoin and Ethereum. I think the AMM DAO protocol tokens, Curve, 1 inch, Uni is a different story. But Bancor, Kyber's going to find its place. But these are really becoming financial primitives, real fundamental components of a financial system. And I've had the discussion with everyone about their monetary policy, and frankly, that it's empirically been proven to be sustainable. And that's extraordinary given they have an inflationary and deflationary component and a relatively stable and growing asset price. So their monetary policy has been proven uh, that the deflationary component balances the normally dilutive effect of inflation. Fascinating, or the debasement effect of inflation, which is exactly what we see in fiat. Can you imagine if the Federal Reserve said, yeah, we're going to burn $100 billion a week? That would be a deflationary component. And that's exactly what these protocols have in place, especially Bancor with the Vortex. And Kyber has that in place. They have a burn component. And frankly, the incentives to lock value in these pools because of the rewards, that is a supply disruption. So that's a deflationary pressure. These are far superior monetary policies as compared to anything any sovereign, any country in history has ever deployed. That's what's going on. Security, to me, do you think interest on stablecoins, for example, DYDX, will go down a lot once we hit a bear market? I don't know. We will see. But what's pertinent is that's how you balance a portfolio. Not constantly, but you're strategically redeploying value to maintain a recurring revenue stream and be protective of your principal value. We know that the value of the principal will fluctuate up and down. So if you're predominantly in stable coins, you have no chance of it depreciating other than the fact that you need to have over 15% interest to account for debasement of its value. So the dollar stable coin is not going to go to 90 cents, but the dollar stable coin only goes so far in the real economy. So you need about 15% interest at least to account for real world debasement. How small a position is too small to add to an LP? So this brings the point that's important for a lot of folks to consider. Um, my recommendation is to accumulate. So, and do it with dollars. If you're new to crypto, your dollars should definitely be in something like USDC or GUSD. GUSD and USDC are the two most regulated stablecoins in the United States, on the planet probably. Um, it's Gemini and Coinbase. Coinbase is about to go public at $100 billion valuation, and Gemini is the Wall Street of the crypto space. So those are great places to reallocate dollars to get into the crypto space. And deploying those dollars where you're getting dollar denominated yield makes all logical sense for the first place for new crypto entrants to deploy capital. Those are likely, rationally, the least risky places to deploy capital. So DYDX is cool. They use your capital to facilitate their leveraged positions, and those positions are programmatically controlled to liquidate. So, in the case of the bet is going against someone's favor. So and those are based on algorithms that have been in development and empirically tested over the last year. DYDX is a massive, massive platform, and Curve, same story. I mean, these yields are denominated in the incentives are denominated in Curve, but throw your Curve into VE Curve for a secondary recurring revenue stream, which is maintained sustainably by intelligently crafted monetary policy. And you're also getting the yields. Look, here's a dollar pool that's going to give you 8.33%. Let's expand the pool for the fun of it. Let's see what else there is. I mean, there's a lot. I mean, curve is big deal stuff. Look, you get some serious single digit percents on your dollars, but then you go over to Bancor and you go over to the data tab. If it loads, there you go. And you got some serious yields. You're getting 33% on USDT, 31% on DAI, 31.5% on USDT, USDC, 33%. But you also get 15% on Ethereum, 8% on Link, 8% on WBTC, and that's not even including the incentives. Getting 110% incentivized yield, over 125% incentivized yield on USDT. You're getting 40% incentivized yield on your Bitcoin. I mean, come on, this is crazy. So these boys, and here, how do you do the risk analysis on this asset or this protocol? Bancor is some of the smartest people on the planet. They have been in development and were deployed back in probably 2017. This was last crypto cycle. These guys were the first AMM period. And these boys were doing their bonding curve, and I'm sure they were in development back in 2016, maybe even late 2015, starting to create what they were thinking of. So if I'm ever going to allocate value to a risk on position, I want to allocate value to people's intelligence, their brains, which is why Rook is a very fascinating, Keep It Down is one of the most fascinating projects, but it's currently completely risk on because Rook, albeit you can put it in Bancor if there's space in the pool, but it's really a predominantly risk on asset. But point being, I want to allocate my value towards the most intelligent people on the planet. And I'm inclined to think that the persons behind One Inch Exchange, Curve, Bancor, Uniswap, Bouncer Labs, Kyber Network, this is not trivial shit, guys. And these protocols have been extraordinarily resilient in the face of security breaches on a lot of the other DeFi protocols. These guys are the titans of industry. And I've made the analogy before to like Steve Jobs, and then Wozniak and those boys in their garage, and Bezos in his tiny little micro office. This is how it's starting. It's obvious where things are heading in the next 10 years. Let me see if I could keep up with the questions. Suds in the house, always a pleasure. Matthew, can you explain the concept behind epoch on synthetics and what that means for claiming rewards? So basically, you're going to get weekly synthetics rewards. Reminds me, I got to go check. Bear in mind, synthetics is managed by L2. There's no gas fees anymore. There used to be exorbitant gas fees in order to claim your weekly yield, but there's not anymore. So synthetics is pretty much pioneered some of this monetary policy. Synthetics might be one of the most important protocols on the planet right now, other than these DeFi protocol, these AMM protocols. Synthetics is a great place to park value. Synthetics has been one of my most successful applications of value starting in 2020 with a synthetics position at 70 cents. I'm pretty sure folks know that synthetics is trading at over $20 at this point. And I'm riding on just pure gains at this point. Just one of the most impressive platforms I can technologically or think of with regard to its technology. Sushi, yeah, sushi is a big deal. There's a lot of I see volatility or uncertainty, and their 2/3 escrow annoy me. So I don't know. I wouldn't shy away from it, but it's something that I don't need to apply value to it. I see unnecessary risk, or I see uncertainty, and I don't like that. I like what I've seen from the other protocols better, and that makes me feel more comfortable, and that makes me sleep better at night. And that's the most important thing. You got to be able to deploy value and not fear that it's going to lose value. And that way you could see a 20, 30% drop in the market and be like, all right, it'll come back. And the entire time I'm generating 110% on my USDC. or 97% on my Bancor, BNT. Yeah. Ryan saying you need to pull out of Nexa. You have to take the information that I provide and digest it and take action accordingly. I will never say actions to take. I will never recommend assets to choose. That's not my role. I am not that type of financial advisor. But my role at this point is education, conversation, analysis, and definitely focusing on the macro perspective. What are your thoughts on Venus Protocol? I know nothing of it, my friend. Squanchy, Bancor, Rook, yes. Rook is live on Bancor. Obviously, the pool is probably limited, is probably filled at this point, and there's a couple of proposals over in the voting section and in governance to expand the pool and provide impermanent loss protection, so on and so forth. Ryan, can you illuminate the distinction between APR and incentivized yield on Bancor? Where's the gas price expense come into play? You're going to spend a fortune deploying value to these contracts. 348 Gwei. I wouldn't be surprised if the deposit transaction is $750 to $1,000. So this does price out a lot of market participants. But in all honesty, if you throw it around 100 grand, and you could get 110, $120,000 a year, and that's where these types of markets have drifted. So what you're looking at with Ethereum is the platform with the network effect. Historically speaking, platforms with network effect are not disrupted. Lyft will not disrupt Uber. Apple still has not disrupted Microsoft in the business market after all these years. They had to create a completely separate market. And that's exactly what's going to play out. Ethereum is the Fifth Avenue. It's, London Diamond District or whatever of the crypto space. And that may change with EIP 1559 and Ethereum 2.0. But that's why Avalanche picked up speed, and that's why Bancor Smart Chains picked up attention, and that's why Polkadot and Cosmos and Elrond are big pieces to the puzzle, because we're going to need other markets that are more cost effective to deploy capital with lower fees. But inevitably, after you accrue enough value, you'll graduate to operating on Fifth Avenue, and that's where the big boys are throwing around money. That's just the way it is. Charlie G, the titans of industry. I love it. I mean, these boys are brains. I mean, come on. This is going to suck in so much value from the legacy financial system, so much liquidity. I mean, literally, they're just afraid. 33% yield with 110% bonus on dollars. Oh my God. They just don't understand. And that's giving people an extraordinary lifetime opportunity to generate exorbitant amounts of revenue in a short period of time. The smart money is deployed now. Wall Street's late money. They're going to be late money, and it's going to be breathtaking that Main Street has been able to front run the crap out of Wall Street. Mohammed, are you eyeing any of the newer protocols? Yeah, there's only one. It's just Alpha, but Alpha is they had a security breach recently in their 2.0 protocol, but their 1.0 protocol has been quite effective. But those boys are smart, and I like that they're working with Yearn. And I like, I love that DeFi Lego functionality and the interoperability and how everyone's plugging into everyone. And I like their products, leveraged yield-bearing positions. That's really cool. I just don't need to deploy to them. The majors, just these are the majors, and the majors are lucrative enough. I do not need to pursue excess risk in order to reach the capital yield that I'm looking for. So that is always in the risk analysis equation. Do you need to take on excess risk to build capital? And that's exactly why people throw around, all their money into like Digibyte. Digibyte could easily go to like a buck 50 in this cycle in the coming months. And that's a big win. But it could also smack a 200 EMA and you buy it at the top and it rips down 40%. You just lost 40% of your money. So that's why it's a risk on position, unless there's a feedback loop that creates a self sustaining momentum. and a reason for the asset to appreciate over time because of a deflationary pressure, so on and so forth. So we got to understand monetary policy. And I know folks will go back to, the decentralization of that argument. Yeah, those are fundamentals. Fundamentals tell you where to look. Technicals tell you when to look. And fundamentals aren't going to technically prevent you from getting a 40% hit on your portfolio. So you can love the fundamentals all you want. Digibyte is one of the most impressive projects with regard to its fundamentals. I love it. I think it has the potential to change the world. And that's meaningful because the world really needs decentralization. It'll benefit everyone and everything financially and psychologically and sociologically. But I sure as hell am not going to risk capital loss on hope and dreams of a better world. So your allegiance is to your portfolio. You've worked too hard to jeopardize and take excessive risk. Look for the monetary velocity. Understand the monetary policy. Monetary velocity is what sustains economies and what grows economies. It's exactly the way we look at the legacy financial system. If you look at M2 monetary velocity, it should pick up, and we'll see that with the reflation narrative. We'll see M2 velocity go vertical, and that's exactly what happened in Weimar, Germany. Went vertical for 9 years, or was it something like that? And then 1 year it completely got destroyed. And that's what we're seeing. We're seeing some incredible monetary velocity in the DeFi space. That's the bottom line. Voting to expand Rook Pool now. That's right, Squanchy. You know the deal. Franz, how many percent of your portfolio is now giving yield? 100%. Every single position, every single asset produces yield in some way, shape, or form. 100%. I do not have any naked risk on positions. No asset unless it's in a pool. No asset. Look, even Cosmos produces inflationary derived yield, 20% a year. IrisNet, BAM Protocol, Kava, and those are the Cosmos assets. Polkadot's producing interest, inflation derived, but it's also one of the biggest assets in the entire crypto space. So every single asset produces yield. That's the name of the game. Yeah, I have to take advantage of that. Like yesterday, use percent gains. Always take advantage of an opportunity. And now the opportunity is to contemplate how to proceed, how to protect the value, and how to structure a portfolio that is extraordinarily risk considerate. Everything I will talk about and continue to talk about encourages extreme risk aversion. Protect your capital at all costs. And sure, I've taken risk on positions. Take a massive, massive risk on Rook position at 60 something dollars. You can imagine how that turned out. Love that protocol. Fundamentals tell you where to look, technicals tell you when to look. Love Keeper down. That's awesome. That is on my eye. But watch your damn risk. Technicals tell you when to look. Took a fat dump. It was $800. I saw it at like 4 and change. Protect your gains. I am JD. What's up? How about Ren? Ren is you need a master node. You need a dark node. Locked in dark nodes. The Ren dark nodes are probably one of the most lucrative investments you'll make in your life. The odds are a dark node will be probably cranking out $100,000, $200,000 a year in the coming years. Each dark node. That's my gut instinct. Doesn't mean it's right, but the whole point of what we're doing is we're speculatively allocating value to outperform markets, outperform other assets, and try and set up recurring revenue streams so money works for us instead of us working for money. So if you're just naked Ren, holding Ren by itself, you have a risk on position. You are fully exposed to all appreciation and depreciation. And sure, you can throw it in a liquidity pool. Here, Ren, producing 10% and 19%. All right. Is that good when you could get 140% on dollars that have 0% chance of depreciation? You're still taking a massive relative degree of risk because the yield it's always risk versus reward. And the risk here is large because it's an asset that is highly volatile and it's not giving you an immense relative amount of yield. Whereas with USDC, the risk is basically just counterparty and smart contracts and I don't know. That has been completely de-risked in my opinion. USDC, it's so damn regulated. But you talking about platform risk, maybe the smart contracts for the platform. That's about it. But you're getting 140% yield. So the risk versus reward is extremely skewed, literally towards dollar crypto. That's crazy. That is incredible opportunity. Um, if you stake every token you have, you can earn yield and asset appreciation. My man Lewis has seen the light. Yield is starved in the legacy financial system, and yields are vertical, parabolic. And what's so fascinating is folks don't necessarily see that these are sustainable yields. If you go over to Binance Smart Chain, you're going to see 1,000 to 10,000% yields. They're fucked. You know who saw that? I saw that. We saw that back in 2018 with masternodes. It was a masternode frenzy. And frankly, if you still do it, masternodes.online. Check this out. You want to see what's going to happen with? All right, maybe they. All right, that's not good. Let's not go to masternodes online. um, So Masternodes Online is used to show you the yield that Masternodes, the inflationary yield that Masternodes were creating, and they were 10,000%, 50,000%, and that's exactly what's going to happen to Binance Smart Chain. NFTs are cool. For me, I don't diversify too much, but I'm in Gods Unchained. I think if I'm gonna have NFTs, I want to freaking play games with them. And Gods Unchained is nostalgic and you know really quite in line with Magic the Gathering. So I got a I got a penchant for that game from my youth, and I really like those assets. They're free, worth a fortune. Some of those assets are worth 30, 40, 50, 60 Ethereum. It's crazy. Nice question, Ryan. My man, what do you think of that? Let's see, the NFTs. So yeah, that's cool. Go for the NFTs, but you're gonna find that they're quite inflated. These Pokemon and Magic the Gathering. These cards are worth $500,000 a point. The real cards, the old school, beta and alpha cards from Magic the Gathering, first edition Pokemon are worth an absolute fortune. What does it take to run a Ren dark node is 100,000 Ren, which is probably like 120 something $1,000 right about now. Uh, Back in March of last year, they were $6,000 to $8,000 a piece, and now they're worth 120 grand a piece. And when Ren spiked to $1.70, they were like $180,000 a piece. Crazy. All right, boys and girls, let's wrap this up. 12:08 p.m. on a Tuesday, February 23rd. 43 people in the stream, 20 likes. We can do better. So I wish you all a wonderful day. Thank you all for listening. I hope I help. Risk aversion, take less risk. Understand how much risk you're taking. It's not worth it. Fundamentals tell you where to look. Technicals tell you when. Sure, you can take a calculated risk, but you have to be on top of the technicals to watch for damn depreciative events like this. I mean, this was a fat dip. This hurt a lot of people that were naked, exposed to risk on assets, and that's unfortunate. It's the same thing that happened with NASDAQ. Come on, this is brutal. And frankly, the fact that it's below the 200 SMA and EMA, this does not look good. But what looks good is the fact that as QQQ dips, Bitcoin is going to be seen relative to NASDAQ is outperforming, which is going to catch the eye of market actors watching for one market outperforming another market. And that tells you where they're going to allocate their value. Value is allocated from underperforming markets to outperforming markets, from inflated assets to non inflated assets. And relative to NASDAQ, Bitcoin is a non inflated asset class, a non inflated market. How about that stuff? I wish you all a wonderful day. I will see you tomorrow. See you then. Peace.